Good afternoon, everyone. I am Praveen Soni, Central Council member of ICSI. I extend my warm welcome to all the participants in this very first webinar of the fifth edition of Enable, Evaluate and Excel, that is EEE webinar series, an initiative of the Institute of Company Secretaries of India to help its members refresh, enhance and update their knowledge of corporate and sector laws. Friends, I would like to place my sincere thanks to Sri Dhananjay Shukla ji, President ICSI, and Sri Manish Gupta ji, my Council
I hope I am
President
visible.
and Chairman of the Corporate Law and Governance Committee of the ICSI, for giving me this opportunity on this very first webinar of the EEE 5.0 series. Friends, I just got the communication from the President ICSI also. He is occupied in the Ministry of Corporate Affairs officials meeting. Otherwise, he would love to address there into this webinar. I would like to convey the message that our institute is committed for capacity building of our members and holding of evaluating regulatory frameworks, and that is the purpose for which the recent chartered secretary issues has come out on the different topic of direct taxes, and next month we are expecting on the Panchayati Raj. So institute is definitely there to handle the members and to framework and the evaluatory regulatory network on this additional laws which are applicable to the company secretaries. In light of the enthusiastic and overwhelming response of its previous editions, where more than 120 webinars were conducted on contemporary topics of professional interest, the fifth edition of this vital webinar series is launched recently as EEE 5.0 Master Series in the third National Women Conference recently held at Indore on 28th and 29th of March 2025. Friends, the Prevention of Money Laundering Act 2002 passed certain obligations on the reporting entities and Financial Intelligence Unit India, FIU India, and have implemented the AML and CFT guidelines effective from June 19, 2023. And that is for the professionals, including company secretary in practice, to establish an efficient reporting mechanism to prevent money laundering, terrorist financing, and qualification financing. FIU India has emphasis to conduct more and more outreach programs for the sensitization of the professionals on the compliance requirement and obligations stipulated under the AML CFT guidelines, and keeping same intent and to sensitize our members on critical aspects of risk assessment under AML CFT. Today's very first session under umbrella of EEE 5.0 Master Series is scheduled on the topic risk assessment and supervision of professionals. Friends, when we are talking about the reporting entity as notified by the Ministry of Finance by its notification dated May 3, 2023, this means that the company secretaries or chartered accountant or the cost management accountant in practice carrying out their certain financial transaction during the course of its profession. So reporting entity has to adopt the risk-based approach to identify and assess the money laundering and terrorist financing risk to which the reporting entity is exposed, depending upon the nature of its business and exposure and involvement with certain types of clients. The risk-based approach of the reporting entity shall ensure that AML and KYC measures are strategically aligned with the specific risk profile of each client or transaction. Risk assessment is a structured process that enables reporting entities to identify, analyze, and manage the risk associated with the money laundering and terrorist financing across their business operations, and company secretaries play a pivotal role in ensuring the appropriate risk mitigation strategies and plan are developed and put in the place to minimize or avoid the potential effects of the identified risk. Risk assessment is not a one-time activity, and the reporting entity must periodically review and update the risk assessment to reflect changes in the business environment, customer behavior, and regulatory aspects. As we all know that identifying and understanding the risk resource is essentially the first and foremost remedial action to fight money laundering and terrorist financing activities. It's crucial for the company secretaries also to understand that proper risk assessment under the AML CFT measures of the country is important to safeguard the illicit financing, terrorist financial activities, and money laundering efforts. In order to gain in-depth understanding of the risk assessment under the AML/CFT and supervise our members in adopting best practices for such risk assessment, today's session is scheduled, and it is our privilege to have two eminent speakers from the Department of Revenue, Ministry of Finance for the deliberation on the topic. Because of some reason, Mr. Smarak Swain is not there, but we are thankful to Ms. Kanika Wadhwan for joining us. Ms. Kanika Wadhwan is Joint Director from Ministry of Finance, and Mr. Agam Shukla is Legal Consultant. I'll give the brief profile of Ms. Kanika Wadhwan. Ms. Kanika Wadhwan is Indian Economic Service Officer 2014 batch. She is graduated in MS Economics from Indian Statistical Institute, Delhi. She has been working in diverse roles in the Ministry of Finance, including working on economic survey, investment treaty negotiations, infrastructure financing issues. And last year, she has joined the Department of Revenue as Joint Director in FATF cell. We welcome you, madam. Next one speaker with us is Mr. Agam Shukla. He is distinguished AML CFT expert, currently servicing as a legal consultant with the FATF cell, Department of Revenue, Ministry of Finance, Government of India, and is recognized for his deep expertise in anti-money laundering and countering the financing of the terrorism. He specialized in the policy formulation, legislative drafting, and ensuring India's compliance with the FATF standards, contributing significantly to the nation's global finance and security framework. He has been instrumental in strengthening India's global compliance by contributing to high-risk initiatives such as the Mutual Evaluation Report and the upcoming National Risk Assessment, identifying vulnerabilities and proposing strategic countermeasures. It is our privilege to have them as speakers for today's session and get benefit from their words of wisdom in the arena of risk assessment under AML CFT. And with this, we welcome both of them at the first session of the EEE 5.0 Master Series and hope to have an enthusiastic learning. My request to all the participants to raise your queries on the chat box, and the same will be taken up at the end of the session. So with this, I request and I invite the first speaker and Ms. Joint Director, Kanika Wadhwan ji, to kindly address on the topic. Over to you, ma'am.
Thank you, Praveen ji, for this warm welcome. It is indeed a privilege and an honor to be a part of this conference and to share my thoughts on the risk-based supervision for chartered accountants and company secretaries, which have been recently included. Recently, in the sense that in 2023, we had passed a notification to make them as REs under the PMLA Act. And of course, I would like to put on record the immense contribution of ICSI in the mutual evaluation of India. As we all know, in 2024, India had completed its mutual evaluation, and the FATF had raised it us as had put us in the regular follow-up category, which is the highest which we could have got at an international platform, which is the FATF. And we also want to sincerely thank the contribution of your officers of ICSE who were very keen in participation during the ME process. So in 2023, as was pointed out by Mr. Soni, we had included them as designated entities under the PMLA, where all the DNFBPs were meant to be the reporting entities. However, during the time of our ME, the FATF had noted that this is a very recent sector because the amendment has been moved recently, PMLA. So they said that the understanding of these risks in the sector is at a very nascent stage, at a very beginner's level, and therefore they could not, they said a lot of scope is still there to understand the risks of this area. So we had taken this up in a very positive spirit, and we understand that the sector does not have a very mature understanding. So what we are doing to make it, of course, kind of streamlined is that one, we are conducting the national risk assessment at a national level. As you are aware of, we're going to publish it in 2025, and the process has already begun. But what's important to the national risk assessment is the sectoral risk assessment. So we would recommend that ICAI and ICSI would do a sectoral risk assessment, because how would you carry out the first question that, all right, you have to follow a risk-based approach towards CDD or towards STR filing. But the point is, how do you do that risk-based assessment? Only when you have a sufficient knowledge of what the risks are. Right? And how would you know how whatever risks are until and unless we do not do a risk assessment of that sector, we will not be able to achieve the RBA. So the first step in this direction is to have a risk-based understanding of what risks operate in this sector. Only then can it be translated into a risk-based understanding, and that will get translated into the practice of following the approach. So talking about the FATF recommendations, there are about two major recommendations pertaining to DNFBPs. One is recommendation 22, the other is recommendation 23. So recommendation 22 essentially, of course, there are many other things, because the recommendation 22 is one recommendation into which a lot of recommendations feed into. So you have recommendation 10 going into it. You have 11, which is for record keeping. 10 is for CDD. 12 is for PEPs. 15 is for new technologies, and recommendation 17 is for reliance on third parties. Agam will elaborate more on it, but these are the broad recommendations which go into recommendation 22. Similarly, we have another recommendation 23, which mandates the filing of STRs. So while the risk-based approach, I would leave Agam to explain it more in a more succinct and a more clearer way. What I want to put on record, like from a bird's eye view point of view, is that with regard to recommendation 23, you have to you're obligated to file an STR with the FIU only if you're undertaking financial transactions with the client. In case you're not undertaking a financial transaction with a client, then there is no mandatory requirement for an STR. But when it comes to CDD, when it comes to doing CDD or enhanced due diligence in case of high risk profile individuals, that is mandatory for all entities, for all your clients basically. So with this, I would invite Agam to make a short presentation, and then we'll be taking up questions on it. Thank you so much.
Thank you, Badika ji. Agam ji, can you start with your presentation, please?
Yes, thank you, and good afternoon to everyone. It's been really an honor to, to address such a esteemed group of organization, which is ICSI, and we are diving into a topic which is risk assessment and supervision of professionals. So it's not just a topic which is just about the compliance. It's also about being how professionals, especially chartered accountants and company secretaries and cost working accountants, can be the gatekeepers of the financial integrity of our nation. So we will get started. I'll be sharing a PPT with you. I'll be sharing my screen in which the PPT would be visible. Uh, Kindly let me know if it is visible. Yes. Okay. So starting with the very basic topic. So we'll kick off with the big player, which is FATF. I'll give a brief intro about what FATF is and what it does. What's the mandate of FATF? I have made it full screen. I hope is it visible.
Sir, I request
Is
you
it
to
visible?
make it for slideshow mode.
Yes, yes, that is what I've done.
But right now it's only PPT version is being displayed on the screen.
Agam, please press F5, Shift plus F5. You're not on in slideshow mode. Just
No,
press F,
I
Shift plus F5.
Yes, ma'am, that's what I've done. And in my screen, it is making in the slideshow mode. I'm not sure why is it not being telecasted in slideshow.
Sir, I request you to reshare your screen. So maybe there's some technical issue or it might stuck.
Okay, let me reshare.
Your screen is visible.
And now I have made it in the slideshow mode as well. Is it
Agam, why
visible in
don't
full
you do
screen?
one thing? I don't think it is full. It is visible. Surbhi, can you just share? Can you like send the slide to Surbhi and maybe they can present it, like online? Can you share your screen and present it?
Yes, I'll be able to do that.
हाँ
Just
तो
share.
प्लीज आप उनको हाँ ईमेल कर दो या व्हाट्सएप कर दो फटाफट से अगम send it to
Yes.
Surbhi and she'll post it
Yes, yes,
on.
yes.
Yes, I'll do it.
Can we meanwhile start with the presentation? I think
Yes.
so. We will do it as and when she receives the same.
Okay, so we'll start with the introduction to FATF. So it's a big player, the Financial Action Task Force. It is a intergovernmental body, an international organization which was established in 1989, and it's the global watchdog, keeping money laundering and terrorist financing in check. So there are 39 members of FATF, which includes India as well, and it sets standards to combat MLTF and proliferation financing. So the mandate of FATF is to, like, basically it provides 40 recommendations and 11 immediate outcomes through which it basically put forth rules and regulations which are to be followed by the member jurisdictions to promote and to protect the financial integrity of the nation and eventually of the entire world. So coming to the recommendations which are subjected to the professionals, so there are two basic recommendations as told by Kanika ma'am as well, recommendation 22 as well as recommendation 23. However, there are certain other recommendations which are intertwined and interlinked with this, as stated by ma'am. Recommendation 10, which is about customer due diligence, recommendation 11, which is about enhanced due diligence, recommendation 12, which is about PEPs, and so on and so forth. There are many other recommendations which are intertwined and which are directly or either indirectly applicable to professionals. So coming to the very basic recommendations which directly apply to professionals, which are recommendation 22. Recommendation 22 basically provides what what who all would be subjected to the rules and regulations of FATF. So basically, it provides certain categories. For example, professionals which are conducting financial transactions, professional which are conducting um, real estate, dealing with real estate properties, professionals which are managing the affairs of the company for or on behalf of their client during their professional course of services, they will be subjected as DNFPBs. Now, section, recommendation 23. Yes, the PPT is visible now. Can you come to slide number 3? Yes. Now, recommendation 23, it talks about the obligation of DNFPPs. So basically, one of the obligation of DNFPP is to report STR whenever they come across. In our case, it is Financial Intelligence Unit of India. So coming to the next slide, we will come down to the AML CFT framework, which is prevailing in India. So Section PMLA, that is Prevention of Money Laundering Act 2002, it defines persons carrying on designated business and professions. And under Section 2, subsection 1, clause SA and subclause 6, it gives central government the power to notify certain persons who can be considered as DNFPBs. So, pursuant to this power, exercising this power, central government came up with the notification of 2023, which applies to professionals, and through which company secretary, chartered accountants, and cost working accountants were subjected to the obligations of the DNFPBs, and eventually PMLA, PMLR, and any other allied rulings and notifications would be applicable to professionals who would be carrying on certain transactions, certain
There
dealing with
looks
real
some
estate property or
bandwidth issue
immovable
from your
property,
side.
managing the affairs of. So that's how all those rules and. Okay, am I audible?
Yeah, you are audible, but look, some bandwidth issues is there from your side. Can you
Okay,
close
so
to the microphone? I think.
let me switch off my video so that my audio would be like much better.
Yeah, please.
Yes. Okay. So so through this, coming to the very point, through the notification, now the professionals are subjected to all the relevant legislations which are applicable to the professionals, which includes PMLA, PMLR, and any other allied rulings and notifications which eventually comes along. So this eventually leads to multiple obligations on the part of professionals, some of them being record keeping, like they have to maintain the records of the information or any suspicious transactions which they come across, and eventually they have to report any suspicious transaction to the regulator, which is FIU India. And then as per Rule 9, Sub Rule 13 of PMLR, they are obligated to conduct their sectoral risk assessment, which will eventually feed into the national risk assessment, which I'll be talking about in the next slide. So kindly switch to the next slide. So let's rewind to 2022. So India conducted its second national risk assessment in the year 2022, which was part of the mutual evaluation process. And some of the key sectors which were highlighted as high risk as per the national risk assessment were real estate sector, cash transactions, shell companies, and in all they were somewhat related to the professionals which were indulged in company formation, asset management, and these professionals and the services which they offer were identified as vulnerable. One of the key issue which was identified in the NRA was concealment of beneficial ownership. And just for the information purposes, India has maintained a public BO registry through which this basically issue is being resolved. However, much more obligations and much more is about to be done in order to curb this issue to the fullest. So coming to the next slide, kindly switch to the next slide. Yes. So India is gearing up for NRA 2025. So we'll be conducting, and we have initially initiated the process of National Risk Assessment 2025, and the professional bodies, the security market regulators, financial institutions, whomsoever are relevant, they are tasked basically to conduct their own sectoral risk assessment, which will be incorporated, the wisdom of which will be incorporated into the National Risk Assessment of India. And similarly, on the similar lines, ICSI and ICAI were also informed to conduct their sectoral risk assessment, so that the very risks which are prevailing in their sector will be identified and measures will be taken to curb them. Coming to the next slide, what are the key risks basically which were identified and which prevail in the professional domain? So one of the key risks is creation of shell companies. Criminals and perpetrators use shell companies to siphon off illicit funds. Then hidden beneficial ownership. This is also a major issue which was identified in NRA as well, previous NRA as well. Creating complex structures. Criminals use these complex structures to hide or conceal or mislead the basically conceal their true identity and siphon off the funds. And some of other key risk areas are Benami shareholdings, related party transaction manipulation, asset concealment through trust, which is a very major source of terrorist financing, just to point it out. Then corporate restructuring, dealing with politically exposed persons, risk related to legal persons and arrangements, dealing in weak ML jurisdictions where the countries which do not have sufficient resources and measures to counter MLNTF. Then one of the key risks is unexplained income. Coming to the next slide. Yes. So eventually we have to adopt a procedure through which we can assess, identify, and mitigate and monitor these risks. So what will be the process? So as it is a good saying, the secret of getting ahead is getting started. And as is pointed out in our ME process as well, professional domain, basically DNFTB domain in India is very nascent. And that is the reason why there are not so much of strengthening measures as there are in other sectors, like in financial institutions, in case of financial institutions. So what should we do? The ME process has identified that these are the key areas where India has to work, even though we getting the best possible category rating in ME process. But how do we get started? So the basic starting point for us is risk-based approach. So what is risk-based approach? Basically, the core FATF principle is to tailor AML safety measures to the basic risk levels. So it is a spectrum basically, from low risk to medium risk to high risk. So what is risk-based approach? Risk-based approach is nothing but a tailored set of measures which are taken up in order to target resources more efficiently and effectively, and apply those preventive measures to which are commensurating with the risk identified. So the three core principles of risk-based approach are identification, assessment, and understanding of the money laundering and terrorist financing risk. Coming to the next slide. So risk assessment. Coming to risk assessment, which is a part of risk-based approach. So how do we get to know what are the risks prevailing in our sector? So it is only through the risk assessment through which we get to know what are the major risks which are to be taken care of, and what sort of resources are to be applied to what type of risk, so that the menace of ML and TF is curbed efficiently. So there are certain criteria through which the risk assessment is done. One of them being client. Then basically in this, say, we could categorize clients in low, medium, and high risk category. So financial institutions which are following all the rules and regulations provided by PMLA and provided under the FATF regulations, they would be considered as low risk category. However, a politically exposed person would would definitely be considered as a high risk personality because of the very nature he's dealing with. So that's how we evaluate the risk assessment for the clients. Now there is services and products and delivery channels. So I would say life insurance policies. There is one product which criminals use very often to siphon off their funds. So this would eventually come up to the high risk category. However, basic pension schemes, wherein the amount of transaction is quite low, they will come up as low category risk. So these are the criteria through which we evaluate and conduct the risk assessment. So these risk variables are basically to be taken care of while conducting the risk assessment, and we have to categorize risk on the basis of these criteria as low, medium, and high category risk. Coming to the next slide. So once we have identified and assessed the risk, the next step is to how do we adopt the procedures to mitigate these risks. Now the risk-based approach is not a zero failure approach. That is to say, we cannot treat every client as a criminal. We eventually have to adopt such measures and effectively allocate the resources in a way that we are able to counter the risk of MLTF very efficiently. So in this way, the clients or the customers which have been identified as low risk, so basically only normal CDD process will be allocated to them, which is verifying their identity, verifying the purpose and intended nature of business and ownership. That is how we evaluate the clients which are categorized as low category. However, in case of high risk clients or customers, we will adopt the process of enhanced due diligence. Enhanced due diligence involve multiple set of mitigation strategies, which include identifying the sources of funds, continuous monitoring of them. Like for a low risk category client, we can either monitor their transactions once or twice in a year. However, for a high risk category client, through the enhanced due diligence process, there has to be continuous monitoring, and every transaction in every quarterly or every high level transaction which they eventually go through, that has to be monitored. And then there are other factors as well which are to be identified. That is the reasons for those transactions to be taken, intended nature of business, sources of wealth and funds, and eventually they have to require senior management approval as well in order to complete that transaction. And the real focus is to be on the politically exposed person and complex structures, which eventually are basically a typical way of hiding the beneficial ownership of a company. So coming to the next slide. So what are the basic components of the risk-based approach? So again, as I stated, consumer due diligence. This is the basic approach which has to be adopted for every client and every customer, which is low risk. And then there is enhanced due diligence. As I said, it has to be allocated to the high risk customers based on the variables and factors which I discussed earlier. Then there is obligation of record keeping, that is to say every data and every information attained through assessment has to be documented. And then STR reporting, which is any encounter of suspicious transaction has to be reported to the regulator. Coming to the next slide. What is the benefit of risk-based approach? So basically, risk-based approach shields the practice of professional from groups, and it builds trust with clients. So basically, it protects the very professional and their practice from exploitation and being used as a means to promote money laundering and terrorist financing. Again, this also builds trust with the client, as there is a customer and principal and customer service relationship between the professionals and their clients. So it builds trust among the customers and their clients. Coming to the next slide. So all in all, here's the bottom line. So professionals can't be just number crunchers or paper pushers. So they also have to act as like the gatekeepers in the war on financial crime. So eventually promoting financial integrity of a nation is the utmost task. That has to be on the forefront. So professionals are one of the gatekeepers who can fortify our stand on protecting our financial integrity. So coming to this, FATF recommendations, PMLA and PML rules and risk-based approach. These are the playbooks for the professionals which they have to abide. NRA 2025, National Risk Assessment 2025 is upcoming. Through vigilance and through teamwork and through the sectoral assessment conducted by the professionals, we will be not just protecting India's financial system, we will also be fortifying it to the extent that our financial institutions and our finances are protected and eventually be used and utilized for the benefit of the people. Thank you.
Thank you, Agamji. Now, Anika ji, are you there? Yeah. So, Agam has already deliberated on the PPT part. Can we discuss on the same and you put on the practical experiences as far as the compliances is concerned and finding out how the risk assessment point is concerned and how this can be regulated and what are the challenges the corporate or the industry do have into this, and as a professionals, as a company secretary, what we can do and what we are supposed to do, something like that. So, in brief overview on the various integral part of the same, somewhere you can put light on this, please.
So, Mr. Soni, as Agam has shown us the theoretical aspect of whatever needs to be looked at from a risk-based perspective. So, like I had said, to begin with, when it comes to STR filing, we have to look at only those cases which are filing financial transactions. And when it comes to recommendation 22, then of course we need to have a thorough risk-based monitoring and risk-based supervision of all activities. For example, there are cases, if there is a business, suppose, which has an annual income of say 10 lakh, maybe 20 or 30 lakh turnover. But if you see an unwarranted large income in that particular amount by that company or certain practices, then probably you need to flag that. And for that, probably you also need to develop something called the red flag indicators, which will be decided upon with all the practitioners sitting down, analyzing what typologies that you have seen in practice. Based on those typologies, you could come up with a list of the red flag indicators, and CSI could kind of send this across to all the reporting entities. And so whenever you see a particular transaction, or whenever you see those behaviors which are shown in those red flag indicators, then that STR could be filed to the FIU. And any other roadblock that your participants, that your REs are facing, of course we would be happy to take up and to sort of clarify any doubts or questions on that also.
Yeah, Kanika ji, see, the topic is very vibrant and new to the topic, new as to the industry as well as the professionals. So there would be a good amount of queries as well as information which people wanted to have as a professional, because it's again a new for the professionals also, and challenges are always new for the companies, those who are integral part of the company, be it as a management or the key managerial personals or the board members or the professionals working with the company and all that. So I do have certain questions, and we would request if you and Agam can also respond on the same, so that we can have a good information flow for the members. I'll come out with some questions when we are just talking about the IT or the AI system which are played into the system. How the transaction monitoring software can play a role into risk assessment. The transaction monitoring software.
Could you please repeat the question? I lost.
I think again there's some. How does the transaction monitoring software play in risk assessment?
So as I understand, transaction monitoring system is used to identify individuals who are placed as designated entities under the UNSCR, certain resolutions, which there is a certain list which has been brought out by FATF. And the transaction monitoring essentially captures, it matches the name of that individual. Those softwares help you to sort of understand whether it is the same person or not. So there are a lot of issues with this. Firstly, sometimes there can be false positives, in the sense that the name might be the same, but in the absence of other information, you are not able to ascertain whether it is the same individual whose name is present in the designated list, or it's a different individual. So for that, we need greater information. And for that, I don't know whether you're aware, but FATF is also working on its updated recommendation 16, where we are trying to, for cross-border and for domestic transactions, we're trying to include greater definition, greater information, which would help to identify exactly what the individual is, whether it is the same person or whether it is a different person. So Agam, any thoughts that you would additionally want to add on this
Yes.
topic? Transaction.
Yes, ma'am. So transaction monitoring softwares, as you said, so basically it involves a lot of training capacity of the individual who would be, using that software. So as you said, the issue of false positives comes along with like these sort of AI tools and software. So one has to be very apt as to its usage and its utility. Along with that, the very professional institution which is using it has to identify its red flag indicators and has to feed in those RFIs into the software, so that they come across lesser false positives and they come across more true matches, through which they can screen the very individual which they are looking for. So the training capacity building and the technical know-how is very important in this regard, and as well as the red flag indicators which the professional institution is looking forward to.
Correct. So when we are talking about Kanika, the risk assessment process, it starts generally from identifying and analyzing the risk and to manage the risk associated with the money laundering and the terrorism financing also. When we are talking about the risk assessment, we need to identify the factors that may expose to the business which are to the money laundering or financing of terrorism risk, then evaluating the likelihood of the risk into the organization, then assessing the potential impact of the effects on the business, then again determining these risks which fall within the organization, then designing the risk mitigation, and again in the last reviewing the adequacy, and then accordingly updating the controls into the management into the various areas of risk factors so that the effective risk management can be done by the company. So my question comes when we are talking about implementation of a risk assessment into the organization. What can be the key components for an effective risk assessment framework which can be established in a company as far as this AML and CFT guidelines are concerned?
So, if you look at, I think it's a new sector. So, of course, I understand that there is requirement of certain kind of a guidance which will help you come up with a framework. But if you look up the FATF recommendations, there are particular pointers which Agam also pointed out in his slide. There are particular factors that can feed into, that assessment, that framework. So, Agam, if you could show that slide, or if you could just elaborate a bit on the particulars which are provided in the FATF. There's a lot of material which can be used from the methodology itself and kind of, juxtaposed into practice. And the one is that. The other thing is that we could also look at internationally. Internationally, there could be various examples of different countries, how they are doing their risk assessment. And because DNFBP is worldwide, I understand it's not just in India. Worldwide, if you see, DNFBPs are not doing a great job in terms of risk-based assessment, and everybody is scoring low. So, but there are certain countries, a few countries, if we could see and if you could, understand what their risk assessment is, we could have some learnings from there. Agam, if you want to add on the key components which is provided in the FATF guidance and the methodology.
Yes, ma'am. Sure. So, the very genesis of risk assessment begins with evaluating the components on the basis of certain variables, which are, first is, as I mentioned, first variable could be client or customer. So eventually the professional has to see who can be a high risk client or customer and who can be a low category client or customer. So this is a spectrum. So for example, and this typology would come up only with practices. There is no strict methodology to identify who can be high risk or who can be low risk. It's all about the practice of the professionals through which they will develop their own typology, since it is in a very nascent stage and not much has been developed about it. But then, considering these variables like nature of business which the professionals are engaging with, clients, as I mentioned, clients and customer could be one variable. Then delivery channels, for example, if a customer is engaging into heavy cash transactions, that eventually has to come up as a high risk personality, and one who is doing banking with a public sector bank, which has proper AML CFT measures applicable, that will eventually come up as a low risk category customer. So these are the variables which are to be taken into account while conducting the risk assessment. So apart from that, various typologies, as ma'am mentioned, internationally, which are being followed, and whatever is provided in FATF methodology and guidance notes, that has to be incorporated while conducting the risk assessment. But then the typology has to be very practical and has to be adopted using the prudence of the professionals, which eventually are in the practical sense, working in the practical sense.
Thank you, Agam. When we are talking about the establishment of the risk assessment framework into an organization, how frequently should an organization conduct the AML or CET risk assessment? Agam, this is to you.
Yes. So there is no hardline rule as to how often a company or an organization should conduct its AML CFT risk assessment. It all depends upon what sort of risk that company is encountering and how the risks are being adapted and how that organization is able to identify those risks and is able to incorporate those into their risk assessment. For example, there are key risks, which I mentioned in my slide as being encountered by the professional domain. But then they are not the only risks which are prevalent in the professional domain. There might be some other risk as well. So currently, if you conduct a risk assessment uh, which eventually has the strategy to mitigate the risk which I have identified or your organization has identified, but if it is not covering the prevailing risk, or if it is not covering the risks which are coming up and which the organization is aware about in their risk assessment, so eventually that leaves a very big gap in basically curbing the menace of ML and TF. So there is no hardline rule, but then that risk assessment has to be updated accordingly as to the risks which are being identified, and eventually every sort of risk and every sort of mitigation strategy has to be incorporated in the risk assessment. So there is no hard line rule, I would say, as to how often it should conduct. It should be very dynamic and should be incorporating of every adapting prevailing risk.
Okay. When we are talking about the new technologies or delivery channel, how this professional can assess the risk related to the new technologies or the delivery channels?
Would you like to throw some light on this, as you were part of recommendation 16 discussion?
Kanika ji, when we are seeing the new technologies coming out to figure out the risk assessment into various transactions between the corporate, so the question came out how the professional can assess the risk related to the new technologies, and to what extent we can have a faith and believe on the technologies.
Yes, so as I mentioned that we are coming up with certain amendments to recommendation 16 which will take care of this aspect. So under the new changes, under amendments to recommendation 16, we have a greater amount of information that will flow along with transactions. So now, for example, if it is a card transaction, it will no longer have just the card number, but it will also have the name of the card holder, and that will help identify and mitigate the risk from all these transactions. So, however, it is under deliberation, and hopefully, maybe by the end of this year, FATF will bring out a recommend. And very recently, we had a private sector consultation also on recommendation 16. So, hopefully, should see.
And adding on to this, as you mentioned about new technologies, as in ma'am mentioned, that FATF is coming up with new regulations related to recommendation 16. So, FATF in itself is providing various type of information which would be available for the professionals to identify and assess the risk. Eventually, they have to be very much aware, and here comes the training and capacity building part. They have to be very much aware about the recommendations as to how it has to be applicable, as to what the methodology of that recommendation is, and eventually they have to apply those recommendations in the practical aspects which they encounter. For example, if they are dealing with a client, they have to apply the pointers or basically the knowledge which is provided through recommendation 16 in their practical aspect. So that's how it will eventually help us to mitigate those risks.
Praveenji, I would just like to interrupt in between and tell you that I have a very urgent meeting in another 5 minutes. So okay. I will have to log out. But my colleague Agam will stay, and he will continue to engage with your team. So
no problem.
I have to leave out. Thank you so much.
No problem. No problem. Before you left, just I have one question actually. I have a practical example of the money laundering activities. This was, let me tell you, let's say it's a Jammu and Kashmir area I'm telling about, and traveling is the biggest business there. So what a scenario or the cases came out when they got the international bookings from the people, and let's say 1 lakh rupees is the travel cost for the tour packaging company, and 1 lakh rupees they get in advance from the upcoming tourist or the visitor who is coming from a country other than India, might be any country, let's say Pakistan or some others, and they take the entire money as an advance. And what happens on the day, 1 or 2 days prior to the date of the actual journey or visit, the booking is cancelled. And as per their rule, they forfeit the entire amount, or they reimburse, let's say they refund 5% or 10% amount as a nominal amount, and they get the entire 90% amount with them. So this way, without doing any transaction, the funding was done. So whether this will also be covered under the AML, and how the transactions can be captured while having risk assessment from the business point of view. So can we have this kind of assessment with the transactions which are done by the people?
Just to get clarity, if I've understood you correctly, who has forfeited the 90% of the travel amount?
Indian travelers, the Indian travel agency into Jammu and Kashmir.
Indian travel agency. Of course, see, now the case, it is not just about a travel agency. It is a particular travel agency which is going to Jammu and Kashmir region, which is politically very sensitive. It is where we see a lot. It's so geographically, India is divided into certain. There are 6 theaters of terrorism in India as per the NRA. So when you look at Jammu and Kashmir, it is a hotbed of terrorism in India. So of course, when you have such transactions, one has to be very mindful of it. One has to look at it with greater details to understand whether this is a genuine transaction or it is an attempt that, like you very rightly pointed out, this was a case where there was no transaction per se. It's just a forfeiture of the entire amount. So of course, these are exactly the things. For example, geographical area is one of the factors, one of the variables, risk mentioning, because in a country, it is not any country for that matter is never homogeneous. There are certain pockets you might have left-wing extremism, certain pockets you might have greater, terrorism. So these things have to be looked at very closely, and I think this requires greater scrutiny, and this should come up as probably a red flag indicator also.
Correct. Agav, you have any views on this?
Yes, definitely. So one of the factor, like the key component of risk assessment, this is geographical location. So in India, Jammu Kashmir being hotbed of terrorism, so one of the risk component eventually feeds into this particular practical case which you just mentioned. So when the case is linked to Jammu and Kashmir, eventually the scrutiny has to be high on the higher end, first of all. Second thing, coming to the nature of services, like it is just an attempted transaction, not the completed transaction, but an attempt to make a transaction and to basically conceal the source of fund and making it as a real money. So eventually this is also one of the red flag indicator. And if the volume of and size of transactions are higher and the frequency of transactions are also higher, then this definitely is a red flag indicator which has to be incorporated in the risk assessment by the professionals, and if anything suspicious is being encountered, that has to be reported to the FIU. So yes, this practical case which you shared, this definitely will feed into as a typology for the risk assessment, considering the variables involved, such as geography and nature of business. Yes.
There can be an exercise of checking into the operations of their travel company, whether at the same time they have rebooked the same premises or same travel plan or same vehicles again for some other customers also, because they are well known and well aware that yes, this person who has done the booking, who is doing that international funding only to them for the terrorism purpose. So they are actually not going to travel or they're not going to come to the country. So on the same date, same place, same vehicle, same hotel, they are doing another booking. So the duplicacy can also be one of the reasons which we can figure out as a risk assessment.
Yes, definitely.
Correct. So now when we are talking about the risk assessment, we know that this is high, low or moderate risk which we are able to identify. Now it depends on the company to company, organization. As we told, Kanika told, geographical location are important to that. And then the business transactions of the company, the services company is providing or the business company is doing. So what can be the criteria or how the company can categorize the risk into the low or medium or the high risk? So
yes.
what methodology can be adopted for this?
So again, I would say these factors, these components which you just mentioned would come into the picture. A professional will look the client. For example, if a professional body or if a company is dealing with politically exposed person, that eventually will fall under higher category because of the very sensitive nature of activities that guy is doing, that particular person is doing. So eventually, these factors, clients, nature of business, and sources of funds, geographical location, products and delivery channels, all these factors come into picture while deciding whether low risk or low risk processes are to be followed, or medium risk processes are to be followed, or high risk processes are to be followed. So these factors basically feed into everything which a company has to look into and incorporate into their practical insights in order to attain what sort of procedures have to be followed.
Agam, how can we assess the risk of a newly incorporated company? We do not have a business history. So for the existing company, we can understand the clientele, we can check or the customer or the money from their flowing or the payment they are making. But what about the newly incorporated company? How we can assess the risk?
Yes. So for the very essential basis of risk-based approach is not to prevent legitimate businesses. So there has to be a very strict balance between caution and allowing the freedom to carry on the activities and businesses. So for a newly informed entity, we basically just have to see whether it is not a shell company, if it is a shell company or not, or we will just follow basic CDD process for them, because eventually they have not posed any risk as of now, being a newly incorporated entity. So we will incorporate low risk measures, which are customer due diligence measures, wherein we will obtain the identity of the owner, look into the very beneficial ownership, then eventually look into the financial transactions which they eventually will, and the nature of business for which the company has been formed, and eventually we will allow that particular company to go through. However, in future, while carrying on their transactions, if we come across any sort of illicit activities from their end, then that will be categorized into high risk category, and eventually enhanced due diligence measures will be incorporated to that particular entity. So for a newly incorporated entity, I would say only CDD process will be followed, and on the basis of continuous transactions or continuous activities which they go through, on the basis of it, if required, EDD measures will be applicable.
Correct. So now I'm talking about the identification of the clients as in high risk or low risk or moderate risk or higher risk categories are there. When we identify them based on their history, based on their layers of investment, based on their funding, based on their nature of working and all that, or their geographical locations also, as you told,
Yes.
and Kanik also told. So how you tell me the professionals can ensure that the enhanced due diligence is properly applied to these high risk clients?
Okay. So basically, enhanced due diligence measures have certain criteria which are to be adopted. So the very first process is customer due diligence, which is for low risk category and which is for everyone. Like this is a process. Enhanced due diligence cannot be made applicable outrightly. First, we have to go through the CDD process, through which we get to know about the very identity of the client, and eventually the usage of transaction monitoring software and usage of screening software come into picture. So through which we get to know if that particular client is from like a geographical location which is susceptible or vulnerable to MLTF, then eventually this is one of the red flag indicator. Then if that particular customer is not coming face to face and is concealing his identity and making transactions without coming directly to the picture, then that is also one of the red flag indicator. Then if that particular customer or a person is doing transactions through a private bank which does not have, or a banking institution which does not have proper AML CFT measures incorporated in their system, so then that becomes a red flag indicator. So through these CDD, so going through CDD measures and these red flag indicators, we come to know that this particular client would be a high risk client and enhanced due diligence measures will be applicable to. So now what are the enhanced due diligence measures which are to be applicable to that client? So we will identify the source of funds of that particular person. We will identify his true identity, or we will force him into like providing multiple identities so that we can assure that this is a real person or this transaction which he is making is a genuine transaction. We will identify about the very sources of funds through which, or sources of wealth through which he attains his um, funds and finances. So these are the basic measures which are incorporated in the EDD through which we get to obtain the very genuinity of the client as well as for the transaction.
Correct. So Agam, I like you just mentioned about the red flag indicator to be made for the high risk profiles and all that. So I just wanted to understand when we are assessing or reassessing the customer profile, what are the red flag indicates? What are the red flags that indicates a need to reassess the customer risk profile?
So I just now mentioned some of the red flag indicators. One being concealing his true identity, not providing like a subtle official valid document to verify their identity, or doing business without doing non face-to-face business with the professionals or with the company. Then some of them could be uh, as I mentioned, anonymous banking, or making anonymous transactions, or making third-party transactions without revealing his own identity. These are some of the red flag. Or engaging with doing transactions through institutions which do not have AML CFT measures applicable in their particular institution. So these could be some of the, and the red flag indicators cannot be subtle. Like, these are the broad categories, but this is always inclusive. Any red flag indicator can be included in this depending upon the very nuanced nature of the professionals which they deal with. So these are the broader category of the red flag indicators which I just mentioned in respect of the customers.
So whether non-disclosure of a significant beneficial owner can also be a reason into that?
Yes, definitely. It is a very major issue, like concealment of beneficial ownership. This is a very major issue which was pointed out in NRA 2022 as well. And India has taken, through MCA, India has taken a lot of measures to curb this. And eventually, concealment of beneficial ownership by creating complex structure is one of the means through which money was being laundered and was being used for predicate offenses, for money laundering as well as for terrorist financing. So yes, this is a major red flag indicator if a person is concealing the true and beneficial ownership of the company. So yes, that is a major red flag indicator.
I'll quote one more example, Agam, for you, so just you can guide how we can be aware of this while having a risk assessment of the organization. An example was, I came to know, it was, let's say, let me talk about the import and export of transactions, or that fruits or nuts from between Jammu and Kashmir trader and one more trader in another country, let's say it be Pakistan. And the Indian trader is exporting the cashew nuts, and the Indian trader is importing the almonds. Now they are exporting and importing as a barter system. So there's no money involved basically. But how the terrorism financing has been done? The Indian exporter is exporting the cashew nuts and he's importing the almonds. And they are getting equal to weight. So let's say 1000 kg cashew nut has been sold by Indian trader. So he is purchasing the 1000 kg of almonds in place of that without paying any single money, and as in barter system. But what has happened basically, let's say the prices of cashew nuts is 25,000 rupees per tons and all that. But the prices of almonds is lakh rupees. So what has happened? Rather than supplying 25% of equivalent weight of cashew nuts to the Indian importer, the Pakistani exporter has exported equivalent weight of almonds to the Indian importer. So what has happened basically, the Indian importer has get 3 times more money than what he was actually having. And now he is getting that money by selling those almonds into the Indian market. So because of that, his 25 rupees had turned into 1 rupees, and 75 paisa he is getting extra out of it, and that too no money is involved, nowhere any currency has been moved out to any account, and the money is generating from Indian rupees in INR only from Indian markets. So can you tell me the mechanism or the techniques or the way of assessing the risk in between these kind of transactions, and to what extent it can be assessed?
Yes. So herein again, the component of geographical location would be involved. Jammu Kashmir being high risk location, so scrutiny would be a bit higher. Again, since no transaction is involved between the two traders of different jurisdictions, like only barter system is there, so we cannot keep a track of what sort of money which is being involved into this. However, like that product coming into India and being sold off over here in whatever price, if it is not genuine, for example, let's say if only 1,000 kgs of cashews are being imported and it is being shown like as 10,000 kgs are being imported and being sold, so this is like, so the quantity is being inflated, and this is a very major issue with export and import businesses, and this is a new form of typology which is identified by FATF, and like functioning are being done to curb this, which is trade based money laundering, wherein import and export invoices are being inflated and deflated in order to siphon off the funds. So this is one of the like new typology which has been identified by the FATF. And over here again, I would say, if the quantities are being like manipulated, or if the very funds which are being generated through the selling off of products are not being traced like in a perfect manner, in a proper manner, and evasion of taxes and whatever legitimate money which has to be deducted are not being done, then definitely that happens to be a red flag indicator, and eventually the scrutiny has to be tightened up.
So is it not suggestible to have a complete track record of the entire transactions and series, and including the previous transactions happened during the past few months or quarter?
Yes. So through barter, basically we can, since we do not have any financial transaction involved, so we will only rely on the very reports of like those barter reports only, which will be provided to the like it would be provided to the customs department only. So that is what we can obtain, and through we can match the very transactions which have been made while selling off the products in India. So if that matches, if the reports of the barter, like the amount of product which has been like imported and the amount of product which has been sold off, that matches, and the quantity as well as the amount matches, then that is certainly not the red flag indicator. But if there is any suspicious activity involved in it, that is to say, if the quantity is inflated or deflated, or if the prices are inflated or deflated, then definitely tighter scrutiny is to be like incorporated.
Taking the same example, let's say if it is not the barter system, an Indian exporter is exporting the almonds, and let's say the market price is 1,000 rupees kg, and he is getting 1,250 rupees per kg from the exporter. So, and this 250 rupees additional is definitely the for the terrorism funding and all that. But how a professional who is assessing the risk or assessing the transaction can say, yes, you have got additional benefit of 250 rupees, which the trader can anytime say, yes, it is my business deal, it is up to me. Whatever amount I am selling, if my buyer is ready to buy, what the issue you do have. So whether how this kind of transactions can be countered, and how the money involved behind this for the illicit purpose can be figured out.
Yes. So over here, like prima facie, it appears that like for a product of 1,000 rupees, you are getting 1,250 rupees. So prima facie, it appears that the prices are being inflated and money might be used for some illicit purpose. So over here, the duty of professional would be, since like most of the red flag indicators are prima facie visible, for example, geographical location, J&K being high risk for terrorism, inflated prices, one of them being this, then the nature of services, like these export and import already are categorized as high category because of the like current typologies being made to siphon off funds. So these are some of the red flag indicators through which a professional can attain an idea that this is somewhat a higher suspicious thing being done. So the very duty of the professional would be to report it to the financial intelligence unit, that is the regulator, for them to carry out an investigation as to whether the fundings are genuine or not. So the very duty of a professional being a reporting entity is to report this transaction and to maintain a record of all the information which has been obtained, so that the FIU can use that information while carrying out the investigation. So investigation part is not for the professionals. It is just a reporting entity which, while coming across any suspicious transaction, as you mentioned in the example, this prima facie appears to be a suspicious transaction being done. So the very obligation of the professional is to report this transaction to FIU, as well as to maintain all the records for the purpose of investigation, which will be eventually carried out by the regulator.
But to what extent this argument of the exporter sustained before the regulators, that he is saying, yes, I have sold it at an overprice, but my buyer is ready to buy, and whatever amount I'm getting is benefit to me, and I will pay tax on this, and this is nothing for money laundering and all that purposes. So how they can satisfy the regulator, or how the regulator can come out of it?
So that justification has to be given to the regulator. So now regulator will ask the very genuine receipts, and even if the prices are inflated, that is fine. If it is if those prices are being used for good purposes, and if the taxes are being paid out of those inflated prices, then the regulator will not do anything. But if that particular importer is not able to justify, or if it is not able to provide the very additional documents, or basically the proofs of the inflated funds and usage of funds, and the very genuine sources of funds, then the regulator will take the necessary action as what is mandated in PMLA.
I think one source can be that what the other dealing, the importer from India is doing, or the exporter from India is doing with other vendors or other customers also. Because if someone is selling at 1,000 rupees to 90% customers, and only one is buying at 1,250, so then there's a big difference. And if, let's say, I am the trader and my one customer is buying at a 250% extra benefit, I should sold my entire products and my materials to the only one seller, only one buyer, rather than giving it to others, because I am getting the maximum benefit out of it.
Yes.
So that could be one of the reasons for this.
Yes. This turns out to be one of the reasons.
Correct. So now my question come out to you, Agam. In what ways should the result of the risk assessment be reported to the senior management or the board, so that it can be interpretive and they can take easy actions based on that?
Yes, definitely. So after conducting the risk assessment, since the professional body would be aware of all the risks which have been identified, then eventually they will come up with their mitigating measures as to how to curb those risks. So it's not a zero failure approach, as I already mentioned. So eventually it might take some time to incorporate those measures into practical insights and to curb those menaces. So one of the very big component over here is to train every individual who is involved in the professional domain to utilize that risk assessment process in order to curb the MLTF risk. So training and capacity building is very essential, and having senior management approval is also like critical. So and in the notification as well, the directors and the senior management professionals are required to be working as like the point of contacts towards the regulators. So eventually they have to be very much aware of the very assessments which their body has conducted. So that's how I believe should be the
Agam, when we are
Yes.
talking about the implementation of AML guidelines or CFT guidelines regulations into the company and corporate, I'm talking about the company secretary or the professionals who is in employment with the company, let's say as in compliance officer. So what
Yes.
role a company secretary or compliance officer do have in implementing the AML or CFT risk framework into the company? And to what extent he can campaign or suggest the same to the company? Let's say if I'm talking about a high risk profile location customer or a high risk profile customer itself, and with a higher amount of compliances required for that particular customer. But the organization is saying, no, you go with the routine transaction framework or routine practices which you are doing. So, what is the role as a company secretary and compliance officer do have in implementing of this risk assessment and the implementing of the AML and the CFP risk framework?
So the company secretary professional or any professional would definitely play a very big role in a company or an organization, acting as a compliance officer, because he being the very person who is having the technical know-how about the every regulation pertaining to AML and CFT. So he will be the person who will be apprising the senior management as to what steps are to be taken in case of encountering any of the potential risks. He would be the person, and compliance officer is also tasked with like the reporting of STRs to the FIU to the regulators. So yes, this being one of the very major role which the compliance officer as a CS professional or as a CA professional has to play. Apart from that, not every person involved in the company or an organization would be aware of the red flag indicators or potential risks which are being faced by the company. However, they would be dealing in that kind of transaction making as well. For example, a person who is just normally advising, for example, in case of insurance company, a policy advisor advises people about like a lot of things, and eventually, if a person comes up to take life insurance policy and that person is not using genuine funds and taking up illicit funds in order to convert those funds into legitimate money by utilizing the way of life insurance policy. So herein, the policy advisor is not knowing about the very technical know-how of FATF compliance or AML-CFT compliance. It will be the role of compliance officer itself in order to track that particular customer as to the legitimacy of the fund and everything. So a compliance officer plays a very major role over here.
How should professional respond when identifying a potential gap in the current risk assessment process?
Okay. So once a gap has been identified by the professional, so it has to be dealt in a way that some mitigation strategy as to how that gap has to be curbed, and these gaps cannot these strategies cannot be like populated in just a minute of a time. Like it requires some sort of allocation of resources, some sort of deliberation, some sort of like understanding of that particular gap as to how it came up in order to implement a mitigation strategy. So the very next step after identifying the gap by the professionals is to adopt a mitigation strategy so that that gap can be filled upon, and that gap does not become some means to be exploited and to be made susceptible for the criminals or the perpetrators to be used as a MLTF means. So a mitigation strategy is, in a nutshell, I would say a mitigation strategy has to be populated in order to fulfill that gap.
I'll come to a question relating to the regulators. As per the RBI and other regulations, we are required to identify the PEP for the purpose of the risk categorization and the CDD. So, what is the source of this PEP list, and how do we determine whom to be considered as PEP? And is there any recommended list for the same?
So, FATF defines FATF recommendations defines politically exposed persons, basically who are involved in like. Basically, if I would say in Indian setup, a politically exposed person would be some politician or would be holding some position of government efficiency like IS officers or IRS officers of a higher senior rank, or any person related to that, like wife of a politician or wife of these sort of personalities. These are being qualified as politically exposed persons. However, PMLA does not define domestic PEPs. So this might sound as a lacuna in PMLA, but we do not qualify Indian politically exposed persons as politically exposed persons, and only customer due diligence, that is, lower risk measures are being applied towards them. However, PMLA does define domestic PEPs. So any of those category of persons who are of foreign jurisdictions would qualify as PEPs for us. However, FATF recommendation defines politically exposed persons, and once you are through their like customer due diligence process, you get to know about the very position of that particular person. For example, if he's a politician in, for say, US, so you get to know through a very basic CDD, you get to know that this particular person is working as politician is US, qualified as politically exposed person or a PEP. Now enhanced due diligence. Again, PEP are in turn categorized as high risk, and eventually enhanced due diligence measures would be applied to them without any fail. So eventually the EDD measures would be applied to that particular person. Very basic CDD,
Agam, when we see the PEP, the politically exposed person, the definition is big, and to what extent we need to go with the definition to the relatives of this PEP, whether it is blood relatives or parents or the other relatives as per company's definition is there or the listing regulations is there. So my question comes out when number one is to what extent we should consider or check deeply the list of relatives as far as the PEP is concerned. Two, when I'm talking about the PEP, the politically exposed person. So there are there are thousands of political parties in India, but only few 40, 50, 80 people participate. Parties are there which are able to get elected. Their people on the MLA or the MPs or the even let's say the municipal corporation. So what about those political parties? They are created on papers only or doing transactions only, but they are not able to get elected any of their officials on the, be it on the municipal or the state legislative assembly. So whether they will also be counted within the definition of the PEP? Over to you.
Yes. So coming to this very point, no, they will not be like just being a member of political party will not entail them to be entitled as PEP. PEPs, because strictly following the definition of PEP, it says head of any political institution like or government or holding any office of public efficiency, being a judge or a judicial officer. So these are the ones who qualify as PEP. Again, a person who is just involved with the political party and not being elected as any MP or MLA or vice versa, that would definitely be not accounted as and entitled as PEP. So no measures would be applicable to them. However, a basic CDD process would be done, and eventually if that person gets elected, for example, in later years, that person gets elected or holds that particular office, which are being provided in the PEP's definition, then definitely that person would be qualified as PEP. But just associated or affiliated with the political party does not entitle them to being them as PEP. Coming to the next question, how relativity of PEPs would do. So their spouses and their children are directly connected to be qualified as PEP. However, there is one more check over here. If a person who is neither blood relative or not related to that particular PEP in any means, but then is engaging with their functionalities, is engaging on the behalf of that particular PEP, then that person will also be scrutinized. That is to say, if that person is making transactions or making any activities which eventually has to be the activity of that particular PEP, but is being done by that particular person, which is not related either through blood or any means, but then that person will also qualify as PEP for the purposes of scrutiny. So the degree of severity has to be taken care of as to how attached that particular person is to the PEP.
Any person working as an employee in a political party, not having any relevance with the political affairs of that party, would that also be amount to be in political exposed person?
No. That person would not amount to be a yes.
Correct. Now I'll come on the my practicing company secretaries when they assess the anti-money laundering risk and the FTs of the clients involved into the cross-border transactions. So how should a practicing company secretary can assess the PML risk of a client involved in a cross-border transactions or operating in the high-risk jurisdictions?
Yes. Okay, so high-risk jurisdictions in itself is like makes them susceptible to and prone to MLTF risk. So this being one of the factor. Other than that, when they are dealing with high risk jurisdictions, they would be required to furnish multiple information and more sort of information in order to justify their dealings. So if a particular client or like a professional is encountering a client not being able to like justify his dealings, not being able to provide the very identity or identification elements or documents which are being requested, then that will populate into the risk assessment as a gap, and that particular client would be subjected to higher scrutiny. Again, the STR reporting and everything, whatever obligations the professional has to follow has to be followed. And that's how, through the scrutiny of these documents, through the scrutiny and verification of these requirements, obligations, it is the professional would encounter the risk scenarios.
Okay, I'll come out with a question when we are talking about the framing of the due diligence policies and the KYC policies for the companies. So, what role a practicing company secretary or the company secretary in employment of the company both can have while finalizing or drafting the this customer due diligence and KYC policies for the company as a part of the AML framework?
So yes, so KYC is part of or a component of customer due diligence only. So customer due diligence is a process which involves identification of customer and obtaining basic information about it. And KYC is one of the steps. So even if a professional is not a reporting entity, and that is a very focal point which I'm mentioning and very important to the professionals as well, that even if a professional is not a reporting entity, that is to say, is not qualified as a professional under the notification which came up, that is to say, not engaging in any activity of buying and selling of real estate or immovable property or managing the affairs of the company, but it should be the duty of the professional to conduct KYC for any of the client which they are engaging with. Through this only, through KYC process only, it is when the professional will be able to obtain as to whether the client is high risk or not. So the professional, even if not being a reporting entity, has to follow the KYC process, which appears to be mandatory itself.
Okay.
And yes,
Yeah, please carry on.
and that's how it paves the way for the professionals to feed into the risk assessment for the very professionals, and eventually these are the very basic things through which the sectoral risks are being identified. So KYC being one of the very major process which um, professionals have to adhere to.
When we are talking about the practicing company's support to the client, implementation and setting up the policies and internal controls and all that. So how my practicing company secretary can support its clients in setting up of internal control for ongoing monitoring of AML or the CFP risk?
Yes. So since professionals are the ones who would be aware of all the AML safety risks of the company, the mitigation measures which only they will be the one who will be populating, and they would be the one who are the main major pivot on which the AML safety framework of the company is being tilted upon. So they play a very major role over here. So for ongoing monitoring, there are multiple scenarios through which ongoing monitoring of a customer can be done. So if a customer is engaging into continuous transaction, so for every transaction, so this is a part of ongoing monitoring. So for every transaction they are undergoing, they will be required to furnish some sort of information which will be determined on the basis of the risk of that particular customer. If that customer is high risk, so multiple source of information would be required. If that customer is low risk, lesser set of information would be required. Then the duration of continuous monitoring or ongoing monitoring would also change. For example, in case of high risk customer, the monitoring, the duration of monitoring could be either 3 months or 6 months, depending upon the volume of risk. For low risk customer, the duration of monitoring could be 6 months or 1 year or even more than that. So that's how like it feeds into the very assessment which the professional as a compliance officer has done for the company.
Again, when we are talking about the practicing company secretaries dealing into with their clients and in regular transactions, somewhere they need to help with their clients and their setting up of the business and all that. So, in what ways can a practicing company secretary can ensure that their own practice also align with the AML or CFP obligations, especially while dealing with the high value transactions?
Yes. So in this case, since professional being the like managing the affairs of the company in helping in setting up of businesses and everything, so they would be having plethora of information regarding the company. So if while conducting their course of businesses and professions, if they come across any suspicious activity being done by their own client during setting up of business or anything, for example, they are trying to like create a complex structure which prima facie feels that it is being created to promote any illicit activity regarding the finances, or if they are like not ready to conceal, they are not ready to reveal their identities, the real identities, and are acting through some different personalities or third party, or if they are not like if they are engaging into unexplained income, these being some of the risks which the professional might encounter while like providing their course of businesses. So during this, if they come across any of these suspicious activities, it will be the duty of professionals to like report them to the regulator and to keep a record of those all the documentation which they have with them.
When we talk about sometime before regarding the significant beneficial ownership, and if somewhere it is not able to trace out, then it is really a reason where high risk is in. Now, what red flags should a PCS, a practicing company secretary, be alert to while verifying the beneficial ownership structure of the organization?
Yes. So they have to obtain the real identity. So the complex structures are deliberately created to conceal the real ownership of the very person. So they have to obtain identities of like every single entity involved. There might be multiple layers of companies, and eventually the funds would be going to a very particular person who is not ready to reveal his identity. So the duty of the professional would be to obtain the certificate of incorporation, MOA, articles of association of every entity involved, and any person holding more than 12% of the shareholding of the company, any person, to obtain the identity of those person, and eventually tracing out who is the real and true owner of that particular entity and who would be benefiting out of the funds of that company, the very entity for which this professional has been working. So that's how like scrutiny, the monitoring basically has to be like very apt and has to be very astute in order to trace out the like real beneficial ownership.
Okay. I'll come out with a practical question which my practicing company secretaries are facing on a day-to-day basis. Let's say, be it a practicing company secretary or chartered accountant or a cost management accountant, when they are acting as an agent for incorporating a company or LLP, or they are following the instructions from the client for incorporating the company, how do we assess the client or check their background? And how do we check if the amount that is being invested in while incorporating the company, let's say subscriber money, this money is coming from the legitimate sources? So how can I check the same, and how can I check whether the company I am creating shall become a shell company post its incorporation itself? So how do we come to know while acting on behalf of the client?
So the professionals have this very say like to provide the genuinity of the funds, the sources of wealth and funds from the clients. They can obtain like the documentation and like the, the sources through which they have obtained these funds, and they are very much be like authorized to do that. Apart from that, the very intended nature of business and relationship, they can definitely be ready to ask about it, and all those things would eventually go into the like documentation of the company as well, including MOA and AOA as well. So they would be very much they should be very much aware of whatever processes are being followed, and being professionals like and like accountants or company secretaries, they would be pretty much aware of the finances of the company as to how and from where everything is being come up. So they have to be very astute, and they have to identify and verify every single document which comes across, and has to ensure the genuinity of it. So that's how they should like ensure that the company which is being created or which is being formed, or an LLP or whatever is being formed, is for a genuine purpose and is not a shell company which is being used to promote illicit funds.
The genuinity I can found from the object clause only, or what commitments or the assurances the client is giving. If I start asking to the client, he will definitely say, yes, I am doing this genuine business. No one will say that I am incorporating a shell company through you only. So is there anything else apart from looking at the document we can identify this is not created as a shell company and it's a real business they are doing? And as far as the sources of money is concerned from the legitimate source, I can only see that the money is coming from the client's bank account or client's other company which they are incorporating as a subsidiary of the company. So how can I identify the same, barring the asking from the client itself, which he will never reveal that true fact, in case he is incorporating a shell company?
Yes. So unless and until that company has undertaken any suspicious transaction which eventually makes it as a shell company, so it would be a bit difficult for the professionals to identify as to whether this company is a shell company or not. So at the outset, it might not be possible. However, during the functioning of the company, like post setting up of the company, if that company is engaging into any sort of activities which raises suspicion, or is promoting any sort of activity or transactions which are illicit, then through these means, like through the factors which I mentioned, like obtaining source of wealth and funds, scrutinizing more about where the funds are coming from, and identifying whether what is being mentioned in the MOA or the object clause and the company is not being able to fulfill it. So these come up as some of the suspicions which eventually makes the professional aware, and through this they can be they can ensure that these sort of organizations or companies are not being misused as shell companies. So the very formulation of risk-based approach is not to stop legitimate business. Again, I would say this is a very focal point, that vigilance and caution has to be very balanced. Like you cannot stop, because eventually Article 21 provides and Article 19 provides freedom to do profession as well as freedom of life and liberty. So the vigilance cannot come across as a barrier to legitimate professions and legitimate businesses. So vigilance has to be very cautioned, and every client cannot be treated as a criminal. Eventually, you have to see the client as doing a very legitimate business. Only when you encounter any suspicion through your risk assessment processes, through the red flag indicators which you have created, and on the basis of the activities, suspicious activities which that particular institution or that particular legal person or natural person is taking into account. So taking into account these sort of things, only then you will apply those processes and procedures. So there has to be a very balanced approach.
Correct, you are correct. Every client cannot be prima facie marketed as a criminal or with the ulterior motives doing an illicit activities, and we need to go on the genuinity of the transactions also sometimes.
Yes, and that's what the focal principle is.
Correct. we are talking about the AML and CFT risk assessment. One general question is there that what are the documentation requirement for the AML or CFT risk assessment?
So basically, the AML CFT policy, every company is mandated to create its own AML CFT policy. As risk assessment methodology as well, like on the basis of components or variables which I have mentioned, and which are like which all FATF also endorses. On the basis of that, they have to have a risk assessment methodology through which they will identify and categorize their clients as low risk or medium risk or high risk, and it contains a lot of variables and scorings which they will give to the clients. So these are the basically documentations which feeds into the risk assessment of a company. So one being set of AML CFT policy of the company, other being risk assessment methodology.
Okay. We talked just now about the transaction monitoring software. So just to understand the importance and the reliability of it, what role this transaction monitoring software play in the risk assessment?
Yes. So multiple like multiple companies provide these sort of services. Like one being LexisNexis, which is also a screening software, and there are many other players as well in the market who provides for transaction monitoring and allied services. So a company has to, as I said, there has to be a risk assessment methodology. So when a company has a risk assessment methodology, they will feed into like that assessment, the scores of that and variables of this assessment into the very software in the AI tool basically, and through which they will encounter whether the person carrying out the transaction is a true match or a false positive. So the role of transaction monitoring softwares in these sort of AI tools are very big. However, there has to be a very efficient manner to use it. And here comes the training and capacity building part, that a person has to be very robust and astute as to how to use it. Because eventually you will come up, for example, if a person is named Ashok, you will come up multiple thousands and lakhs of people named Ashok. And then it would be very difficult for you to screen whether this is the very person who has made the transaction or not. So your risk assessment methodology has to be very robust and dynamic so as to feed in the variables which only comes up with the true matches only and very less false positives. So that's how it has to be like function.
So when we are talking about the risk assessment, we understand and we read with this, yes, the risk assessment is not a one-time activity, it's an ongoing process and need to be done on a quarterly basis or on a yearly basis completely throughout the year. So just need to understand what are the best practices for ongoing monitoring of high-risk customers.
Yes. So DNFBPs being in very nascent state, not just in India and worldwide, there are not a lot of best practices which are available. So every country is in a developing state with respect to DNFBPs, as is encountered by FATF itself. And I don't think there is any jurisdiction which has attained a very good rating in these recommendations which are pertaining to DNFBPs. However, adaptability and like dynamism, these are the two very focal points which professionals have to adhere to. That is to say, dynamism in the sense that whatever new sort of typology or type of risk they come across, they have to adopt it, they have to like be aware of it, and that has to be adopted in the risk assessment risk assessment process of that particular sector. So that's how like these sort of risk can be curbed. So that's how it is.
Okay, so we have covered almost all the questions which we have received. I am taking one last questions which I do have with me as of now. We are talking about the KYC check and the AML check of the customers. And when KYC circular states that the customer with non-face-to-face onboarding are to be classified as a high-risk customer.
Yes.
And if our company is doing a digital lending, then all the customers are face-to-face because they don't know anyone out of it as a customer base. So is it that
Yes.
the whole customer base is into high-risk category?
No. So
I think the
digital
KYC compliance should be a big part into this.
Yes, yes, exactly. And apart from that, as far as digital KYC is concerned, if a person, so this is the very point which came up in like recommendation 16 discussion as well, which is being recently amended. So when a person, so the very thing which was agreed upon was that when a person who is coming like in front of the camera, even if not physically present, but is virtually present by means of either camera or any other means, he is able to register his presence virtually. That person would be considered inequivalent with a physically present customer and would not be treated as a high risk client. However, if that person is not um, allowing us or is not showing his like like true image, like real picture of him while the KYC process is going on, that customer would be categorized as high risk. So the digital KYC regulations, as you mentioned, would definitely come into picture over here.
Can you quote some live example if you have been somewhere in your memory or you would have dealt with a regulator how the AML transactions or the FT transactions has been done during the period and how the regulator has come out of the same, so that the professionals can be beware of this kind of tactics also. Can you quote someone one or two any examples out of it?
So I will provide one example. Recently, when FIU got this report, so there was this pattern of like there was a person who was procuring life insurance policies for himself as well as for his families, and eventually canceling it after some time and taking out that money, whatever is left out of the premium which he has paid, and taking that out after like providing some sort of a penalty for featuring it. So this happened to be a recurring case. So eventually the insurance company filed a STR to the regulator. So FIU India like investigated that case and eventually came to know that the genuinity or the source of funds is not being disclosed by the very client, and the funds are being coming from somewhere from Dubai or like these sort of Islamic nations, and it was used as a means, that life insurance policy procurement was used as a means to make that illicit funds as genuine. So like this is one of the typology which like FIU or a regulator came across, and this could pave as a one of the example.
Okay. And can you suggest some of the tips or some guidance to our members, wherein if any company's transactions is coming out into any disputed or in any transaction wherein the investigation is advised by the regulator, or they found that any territorial funding is there into the transaction. So how the documentation can be in backend kept prepared by the professionals, how they can present their case in a best manner to the regulator, and what safeguard they should have in order to ensure that yes, whatever they have done, they should be able to prove that yes, the genuinity of the DD was there from their side, and they have not kept any stone unturned out of that transaction as far as their professional liability is concerned.
Yes. So in this case, like FIU has like a strict procedure as to how the information has to be provided to it, being a regulator. So the professionals have to adhere to those particular guidelines which FIU has with respect to filing of STRs as well as with respect to furnishing of information, and that is pretty much available in PML rules as well as PML Act only. So these are the, so eventually being a reporting entity, once you are qualified as a reporting entity, PMLA, PML rules, and all the allied legislations and notifications which come across with respect to AML CFT are applicable to the professionals. So eventually they have to adhere to those guidelines only. So maintenance of record rules provides for furnishing of the manner of furnishing of information. So eventually they have to adhere to it. Like they have to obtain basic information with respect to name, date of birth, designation, official valid document, a brief note on, like for STR filing, there is a process wherein a brief note of what appear to be suspicious to the professional has to be provided. Apart from that, certain documents are to be uploaded, certain receipts, financial transaction receipts, or like these sort of documents are to be uploaded. So there are strict procedures which FIU has, being a regulator, has provided, and eventually professionals have to stick to that only.
But whether these procedures differs from industry to industry, or the any something specific pointers are there for the people into highly vulnerable geographical locations, or to the high risk customers, or to the countries people coming from the high risk countries. So is there any something specific notes or guidance are also there?
No, so procedures are like PML rules and PMLA and FIU procedures are like universal to everyone, irrespective of the sector or irrespective of the domain anyone is coming from. So eventually, everyone has to like provide at least minimal level of information which is being provided there. Yes, for specific sector basis, although for professionals or accountants, we have not come up with any specific guidelines as to the furnishing of information or like procurements, but for like financial institutions, they have certain additional liabilities or obligations while providing the information. Like they have to fill in certain I would say forms while providing information. Like they have to provide some additional information on the basis of the forms which they have to fill in. So for professionals, currently it has not come up, but like in future you can expect, like once this is developed into a very like subtle stage, like currently DNFBPs are in a nascent state. So once it is developed in a subtle stage, and once the proper risk assessment has been done and it is identified that this is a vulnerable area which is very susceptible and prone to MLTF. So once this is like identified, then definitely some sort of guidance or additional requirements or obligations would come up to the professionals which they have to adhere to. But as of now, the universal procedures and processes are to be followed which are provided in the legislations as well as by the FIU.
Okay. So I think Agam, we have taken up all the questions which were been raised by the various participants. I think around 20,000 participants are watching this webinar on a live basis, and we have received almost all the questions. We have taken up all the questions. Those who were repeated, we have avoided the same, but maximum questions we have taken up. My sincere thanks to Kanika ji for being participating here, and for giving the thoughts on the and ideas on the and the regulator's view on the topic. Before we conclude, Agam, I just wanted to have your closing remarks, wherein you wanted to communicate any pointers to our members or professionals, those who are practicing as a company secretary or those who are employed into the company as a compliance officer. What the points they should be beware, where they should be alarming in a position or in a whistleblower position, or which are the areas where they should be more careful or attentive while dealing with the company itself or their client itself, as far as this AML or FT guidelines are concerned. So your closing remark, please.
Yes, definitely. So throughout the discussion, we eventually vigiled through a lot of points which were very much required and essential for the professionals to keep in mind. However, I would like to mention that a robust and a comprehensive risk assessment and understanding of the risks which are prevailing in the sector as well as in the domain or in the company which you are working in, a professional has to be aware of that. So that is the very first thing. The mitigation strategy has to come out of the very professionals only, because they are the one who are the gatekeepers of every financial transaction or every sort of activity which is being taken place by the company or a natural person. So that is one thing, like mitigation strategy. Apart from that, they have to be very astute about the obligations which are being provided by the legislations, that is PMLA or PML rules, or by the FATF recommendations with respect to record keeping, and they have to be very true about the very obligation of reporting suspicious transactions. Also, coming to this, like this being the vigilance part, coming to this, they have to adopt a very balanced approach and should not act in such a manner where they like act as a barrier or act as a hindrance into the legitimate businesses. And like eventually once the business flourish, it will eventually help our nation, our country to flourish as well, because like the financial strengthening is the utmost requirement for a developing nation like India. So yes, we should prosper with vigilance, with caution. And with these remarks, I would like to thank Praveen Soni ji as well as the whole ICSI esteemed membership for having me over here. And it was really an honor to speak alongside you and impart whatever little I could through my presentation and through my inputs. And I would definitely like to be a part again if at all any webinar or any sort of discussion takes place in with respect to animal safety. Thank you.
Thank you, Agamji. Thank you for contributing and sharing your time. You have very well explored and very well responded to all the queries raised by all the members, whatever we have received and which I have shared with you. Thank you for giving a detailed brief information about the processes. And yes, the member need to be vigilant. All the eyes and ears, they need to be kept open as far as the company's transactions are going on. And they need to be vigilant not only at the time of audit, but just throughout the year, because this audit is an ongoing process. And every time they need to be vigilant as far as the development occurring into the organization. So my sincere thanks to you as well as Kanika ji for being a part of this webinar. And we missed Smarak ji during this webinar, but yes, Kanika ji filled the gap. Thank you so much once again, part of this. And on behalf of ICSA, we place our sincere thanks to you and contributing your time. Thank you so much. Thank you so much.
Thank you. Many thanks.
We can